Hello, everyone. This is our group of governors here to discuss the Federal Open Market Committee meeting to discuss more about the U.S. macroeconomic environment.
So first, taking a look at GDP growth, GDP is volatile but growing. The first quarter, real GDP decreased by 0.5%, while in the second quarter, it increased at an annual rate of 3.3%. Real GDP in the second quarter was driven mainly by a decrease in imports and increase in consumer spending, which was likely caused by the new tariffs implemented by the current government. These movements were partly offset by a decrease in investment and exports. As we can see on the graph on the right, GDP has really been very volatile, reaching upwards of 7.5% growth in between 2021 and 2022, while even reaching negatives in early 2022 and early 2025. If we take a look at consumer spending, the debt burden, while growing, remains stable. If we take a look onto the graph on the left, the overall debt of households has been growing, reaching upwards of $16 trillion in 2025 compared to only 14 in 2019. However, if we take a look at the graph on the right, debt as a percentage of disposable income has remained relatively flat over the past 2 years. If we take a look at labor productivity, inflationary risks from labor market are subdued. So productivity had growth has consistently outpaced wages in the past 20 years or so. While workers are producing more, their pay has not kept up. If these wages keep lagging behind productivity, workers' purchasing power will grow more slowly. As we can see, the graph on the right, labor productivity has consistently been higher than the real hourly consumption percent growth.
Looking first at inflation overall, according to the Bureau of Economic Analysis, core PCE inflation rose 2.9% year over year in August, after 2.8% in July and 2.7% in June. This shows a stabilization near 3%, just above the 2% target, but significantly down from pandemic era highs. This shows that consumers are still spending, which is keeping inflation pressures alive, but a weakening labor market and increasing prices create some uncertainty as we look to the future. Breaking core PCE into its components, the BEA data shows housing inflation has declined from a peak of 8.27% earlier this year, though it remains elevated. The San Francisco Fed Supercore Tracker shows that core services, excluding housing, have slowed to about 1.96% on a 3-month average, a strong signal that persistent inflation is easing. Core goods, however, are still sticky at about 2.3%, largely because of ongoing trade frictions and tariffs. However, inflation has not been felt equally across the population. According to the New York Fed's economic inequality indicators, minority groups and lower income households face sharper inflationary burdens in recent years, as lower income households have to spend a larger percentage of their income on more volatile goods such as food and energy. But in the most recent data, these gaps have narrowed, with wage growth among Black, Hispanic, and lower income workers converging toward overall averages. Now looking at wage inflation. According to the Federal Reserve Bank of St. Louis, the 3-month moving average of median hourly earnings showed that job switchers once saw pay gains well above 7%, but that growth has steadily fallen. For job stayers, as seen on the graph, wage growth has been flatter, hovering closer to 4%, and the gap between switchers and stayers has narrowed significantly compared to the pandemic period. This is important as it shows that job switcher premium, a big driver of wage inflation during the labor turn of 2021 and 22, has narrowed sharply. In addition, overall median hourly earnings growth has also cooled to around 4%, down from the peaks of 6 to 7% we saw in 2021 and 2022. This matters because wage growth is a key driver of service sector inflation. The fact that wages are moderating alongside supercore PCE, as tracked by the San Francisco Fed, suggests that persistent inflation pressures are easing.
Now, when we look at unemployment, it remains historically low, but broader measures like U6 show persistent underemployment. Youth unemployment has risen post-pandemic, reflecting fewer entry-level jobs as firms cut budgets and adopt artificial intelligence. This points to slack within specific groups despite overall labor market strength. Now, the labor demand is cooling. The quit rate remains elevated and layoffs subdued, but the hiring rate has declined. With the vacancy to unemployment ratio slipping below 1, the data signal weakening demand and rebalancing of the labor market. Now, the beverage curve further illustrates this adjustment. After the pandemic, the curve shifted outward, reflecting a mismatch and some frictions. Over the past few years, however, job openings rose much faster than unemployment, pushing observations back up to the y-axis. More recently, we see movement toward the northwest corner of the graph, uh, showing the pre-2020 range and signaling softening demand and growing signs of labor market weakening. The labor force participation has nearly recovered, which is a good a sign, especially among prime age workers, but it remains below the pre-pandemic levels due to aging demographics. Since peaking in 2023, participation has edged down, showing early signs of supply contraction.
Now, if we take a look at broader financial conditions, there's extreme looseness in the market in times of financial growth. So we can see, looking at the graph on the left, the NFCI has been more negative now than it has over the past 2 years or so, signaling a looser economy as a whole with easier access to credit. To the graph on the right, we can see that the financial conditions impulse on growth index has also become negative over the past year, signaling a tailwind 3-year GDP growth. This shows that while the economy is very loose, it is still growing rapidly. If we take a look at pricing levels, housing continues to rise while equities reach valuation highs. The Case-Shiller index shows rapid growth in housing prices, spurred by inflation and consumer confidence. At the same time, the Ford S&P 500 P ratios climbed post-pandemic, mirroring consumer confidence while hinting at a potential AI bubble in the near future. We can see that to the graph on the right with both the Case-Shiller index and the S&P 500 Ford P ratio both growing substantially over the past 2 years. If we take a look at market expectations, there's high volatility without increased risk. The 10-year swap volatility in 2022 reached higher levels than the height of the COVID-19 pandemic. At the same time, equity risk premium has decreased steadily as consistent market returns and compounding consumer confidence have diminished risk. We can see that as over the past 10 years, the implied volatility of the 10-year swap has grown substantially, while the equity risk premium has done the opposite, decreased, with them even crossing each other around 2022. If we take a look at broader credit conditions, banks have tightened lending standards despite strong delinquency rates. So if we take a look at the net percentage of domestic banks tightening standards, we'll see that over the past 2 years, there's been a slight tick in tightening standards. However, delinquency rates have also grown, as we can see to the graph on the right. This is especially true for more personal loans, such as credit card loans and consumer loans, while single-family residential mortgages have remained relatively stable in terms of delinquency rates over the past few years. So also looking at long-term rates, we'll see that higher federal funds rate raises other key interest rates. The 2-year US Treasury note and the 10-year US Treasury bond have dipped below the federal funds rate, signaling an inverted yield curve. Additionally, a persistently high 30-year fixed mortgage cools down the housing market by shrinking demand without significantly lowering housing prices. All this could be a hint at a possible recession. Now, what is our policy recommendation? We believe that with all this, the federal funds rate should be cut by 25 basis points. On top of that, we should take a very cautionary communication strategy. The main headline of our communication strategy should be data dependent. We should be focusing on future inflation expectations, labor market information, and financial stability risk. We should also convey flexibility. Future rate cuts are possible if this inflation continues, but rate hikes are not off the table if there is a possible reacceleration in inflation. Lastly, we should maintain consistency and avoid pivot language that can fuel excess risk taking in the financial markets, which is definitely what we don't want right now.
For the recommendation my colleague presented, these are the 4 factors we believe are most relevant. First, inflation is on the right trajectory. Core inflation continues to drift towards target, and the super core 3-month trend has eased. We acknowledge that some near-term noise for goods prices and policy-related cost pressures, but the broader disinflation path remains intact. A small cut supports this progress without reigniting demand. Second, the labor market is cooling without cracking. Openings have moved closer to unemployed workers, quits and hires have stepped down, and wage pressures have moderated. This is exactly the softening we want to see, enough to reduce inflation persistence, not enough to threaten employment. Third, Main Street is rather cautious at the moment. The Beige Book reports flat to modest growth, hesitant hiring, and more price-sensitive consumers. A small rate cut could help encourage growth in this area. Fourth, financial conditions are loose but stable. The curve remains inverted, and a small cut trims real rates without adding balance sheet liquidity. Thank you for your attention.